In the last 2 years, companies around the world have poured over $10 trillion into artificial intelligence. 10 trillion! And yet, almost none of it is turning into real profit. Stocks are soaring, investors are euphoric, and the headlines scream about a new technological revolution. But behind the glimmer, the math doesn't add up. Imagine Nvidia servers humming endlessly, GPUs stacked like towers of gold, money flowing faster than any infrastructure can handle. Exploding charts flash across screens, reflecting fortunes made overnight. And while the world watches in awe, most people have no idea that this could be the biggest financial story of the decade, the one everyone will talk about after it's too late. This is not a tale of science fiction. This is happening right now, and what you don't know yet could cost billions. The AI boom is everywhere. Nvidia, Microsoft, Google, Amazon, Meta, they're all betting everything on it. Stock prices have exploded, investments are staggering, and the world is buzzing with promises of artificial general intelligence that could change every industry overnight. Every press release paints a picture of a future transformed. Every investor meeting talks about exponential growth, revolutionary breakthroughs, and untapped markets waiting to be conquered. The narrative is irresistible. AI will redefine our lives, our work, and our economy. And yet, amid the excitement, one question lingers quietly in the background. Are these promises grounded in reality, or is the world caught up in a frenzy that could collapse under its own weight? The stage is set, the hype is sky high, and the consequences of getting this wrong could be catastrophic. The problem is simple, yet alarming. Companies are spending hundreds of billions, trillions when you add it all up, on AI infrastructure, research, and talent. And for what? The revenue barely scratches the surface of what's being poured in. The math doesn't add up. Billions flow out the door every year, yet profits lag far behind. The scale of spending is breathtaking, the ambitions are enormous, but reality is starting to whisper a warning. What happens when the glitter fades and investors finally ask the hard questions? When the dazzling projections meet the harsh truth of limited revenue? History has a way of repeating itself. Take the railroads in the 1800s. Investors poured money into new tracks, grand stations, and ambitious lines stretching across the continent. Everyone believed the railroads would make fortunes overnight. Stocks soared, towns boomed, and the excitement was contagious. But beneath the frenzy, the reality was harsher. Many railroad companies overextended, building more than the market could sustain. Revenues lagged behind the massive spending, and eventually bankruptcies followed. Wealth vanished almost overnight, leaving only a handful of survivors with real infrastructure and solid business. The story of the railroads is a warning. Innovation alone doesn't guarantee success. Hype can blind even the smartest investors, and when expectations outrun reality, the consequences can be devastating. Now, look at AI, and the pattern begins to feel eerily familiar. Fast forward to the year 2000. The internet was the new frontier, and investors were convinced every startup would become the next Amazon or Google. Companies with no profits, no real revenue, and sometimes no clear product were valued in the billions. Pets.com, Webvan, eToys, names that once dazzled the world, collapsed almost overnight. The human cost was staggering. Investors lost fortunes, employees were left unemployed, and the market reeled from a crash that wiped out trillions in value. The lesson was brutal but clear. Hype can inflate expectations far beyond what reality can support. And yet, here we are again. The excitement around AI carries the same energy, the same promises, and perhaps the same danger. The stage is set for history to repeat itself, but with stakes far higher than before. The scale of AI spending is almost unimaginable. In 2023, companies spent around $200 billion just on infrastructure, data centers, chips, power, and cooling. By 2024, that number jumped to $350 billion. Projections for 2025? Over $400 billion. That's nearly $1 trillion in 3 years just to keep the systems running. And that doesn't even include research, hiring engineers, acquiring startups, or developing applications. This is purely the cost of building the backbone of AI. Servers humming endlessly, electricity flowing in staggering amounts, and hardware stacks that could rival small cities. It's a tidal wave of money, and while the scale is impressive, it raises a critical question. What exactly are companies getting in return? Because spending like this only makes sense if the returns are even close to matching, and the truth, as we'll see, is far from simple. Nvidia is at the heart of this AI frenzy. Their GPUs, the chips that power the world's most advanced AI systems, are flying off the shelves. In just 2 years, their data center revenue jumped from $15 billion to a projected $100 billion. Every major tech company is buying tens of thousands of their H100 and H200 chips, building massive AI training clusters that cost anywhere from $500 million to over $1 billion each. The growth is breathtaking, almost dizzying. But beneath the success lies risk. Nvidia's fortunes are tied directly to the pace of AI spending. If companies slow down, if the hype wanes, the revenue stream that fuels this meteoric rise could shrink just as quickly. For now, Nvidia rides the wave, but the question lingers: how long can the momentum hold before reality intervenes? Microsoft has bet big on AI, pouring over $60 billion into infrastructure and investing $13 billion directly into OpenAI. They've integrated AI into almost everything: Office, Azure, Bing. But when you look closer, the numbers tell a more complicated story. OpenAI, the company behind ChatGPT, generates about $3.5 billion in revenue, but its compute costs alone exceed $5 billion. That's a $2 billion gap year after year. Microsoft's AI ventures add revenue, but at this scale of spending, even billions in income barely scratch the surface. The investment model is monumental, yet unsustainable. Every dollar spent is a bet on future adoption and growth, and every failure could ripple through the tech giants. The stakes are enormous, and the question hangs heavy. Can these investments ever truly pay off, or is the bubble quietly inflating beneath the surface? Google has spent around $50 billion on AI, building their own chips and offering Gemini for free. But giving away a product that costs billions to run isn't a business model. It's a defensive strategy, a way to compete with ChatGPT and protect market share. Meta has invested over $40 billion, mostly to enhance ad targeting and content recommendations. The AI tools consumers see, they're free, and their direct revenue impact is minimal. Amazon, meanwhile, has spent $30 billion on AI through AWS, Alexa, and fulfillment optimization. But Alexa has never been profitable, and its AI additions haven't changed that.
Across these tech giants, the spending-to-revenue ratio is staggering, about 20 to 1. Billions are being poured in, yet the returns are tiny in comparison. The excitement is real, the technology is real, but the math is sobering. AI can do incredible things. It can write text, generate images, analyze data, even write code. But the question is, will people pay enough for these capabilities to justify the massive spending behind them? Most consumer AI products cost $10 to $30 per month. ChatGPT Plus at $20, Microsoft Copilot at $30, Google One AI Premium at $20. Even with millions of subscribers, the revenue barely scratches the surface of the trillions being invested. Growth is plateauing. New users roughly match those leaving, and enterprise adoption is slow. Integration with existing systems is expensive and complicated. AI improves productivity, but only marginally. The dream of revolutionary change is real, but the reality is much more limited, and the gap between hype and revenue is widening every day. Running AI isn't just expensive, it's astronomically expensive. Training a single large language model like GPT-4 costs over $100 million. Then there's inference, running the model to answer user queries, which adds billions more each year. And the energy demands are staggering.
Training GPT-4 alone consumed enough electricity to power 5,000 American homes for an entire year. Now imagine dozens of models being trained simultaneously, inference running billions of queries every month, and data centers the size of small cities humming 24/7. A single cluster of 10,000 Nvidia H100 chips draws 7 megawatts continuously. Large facilities of 50,000 to 100,000 chips pull 35 to 70 megawatts, costing tens of millions annually just to power and cool. The scale is almost unimaginable, and the environmental impact is enormous. AI isn't just expensive, it's devouring energy at a rate few realize, and the costs only rise as models grow bigger. Nvidia's stock tells the story of this bubble in plain numbers. In early 2023, it traded at $150. By late 2024, it soared past $900, a six-fold increase in less than 2 years. Its price-to-earnings ratio sits around 65, an extraordinary mark of investor optimism. Every dollar paid is a bet on future AI spending, on continued hype, on the assumption that companies will keep pouring billions into infrastructure. Big tech valuations are closely tied to these assumptions. Microsoft, Google, Meta, Amazon, they're all riding the wave of AI investments. But when reality hits, when spending slows or revenue disappoints, the fall could be swift. The stock market is the mirror reflecting the bubble's tension, and beneath the shine lies a risk few are prepared for. The question isn't if a correction will come, it's when and how deep it will cut. Some cracks are already showing. AI startups that raised massive funding in 2022 and 2023 are running out of cash. Investors are asking harder questions. What's your revenue? When will you break even? The excitement that once fueled blind spending is fading, replaced with cautious scrutiny. Revenue growth from AI is starting to slow. The initial surge of paying users has plateaued. Enterprise adoption is taking longer than expected. The first domino is about to fall, and once it does, the effects could ripple through the entire industry. The era of unchecked spending is ending, and the warning signs are unmistakable to those paying attention.
History has a way of repeating itself. The dot-com bubble of 2000 is a cautionary tale. Companies like Pets.com, Webvan, and eToys rose to massive valuations with little to no revenue. Investors poured trillions, and when reality hit, the collapse was brutal. AI today mirrors that pattern. Take Inflection AI, founded by a DeepMind co-founder. They raised $1.3 billion, built a chatbot called Pi, but hardly anyone paid for it. Microsoft eventually acqui-hired the team for $650 million, a fraction of the original valuation. The company burned through hundreds of millions in compute and development, generating minimal revenue. The pattern is clear. Hype leads to enormous spending, spending leads to massive valuations, and when revenue fails to catch up, the crash follows. AI may be revolutionary, but the financial reality is following a story as old as technology itself. Bubbles don't collapse randomly. There are triggers, moments when the illusion of endless growth shatters. The first is a major company failing. When a visible player goes under, panic spreads. The second is revenue growth stalling. Investors notice promised returns aren't materializing, and the excitement fades. The third is costs becoming unsustainable. Companies can't keep spending at the pace they once did, and cutbacks ripple through the ecosystem. In AI, this creates a domino effect. Nvidia depends on ongoing AI spending. If companies halt purchases, its revenue falls. Big tech companies like Microsoft, Google, Meta, and Amazon will decline too, though less severely, perhaps 20 to 40%, because their revenue streams are more diversified. Startups face the harshest fate. Roughly 90% will fail. The timeline is clear. In 2025, AI spending continues, but growth slows. By mid-2026, major companies report AI revenue isn't meeting projections, and investors begin to panic. By 2027, the bubble has clearly popped. Hundreds of startups vanish, valuations collapse, and the hype-driven frenzy turns into widespread disillusionment.
This isn't speculation, it's the normal cycle of technology bubbles. The rise was meteoric, but the fall is inevitable. Some argue that AI could still defy the crash. Costs might drop as hardware improves. AGI, artificial general intelligence, could arrive, unlocking unimaginable revenue. Consumer adoption could explode, fueling profits beyond today's estimates. But the reality is harsher. Current AI is narrow, excelling at specific tasks, but far from human-level reasoning or long-term planning. Even if AGI arrives, the economic model is unclear. If AI replaces knowledge workers, who will have the income to buy products? This is the automation paradox. Technology that eliminates jobs can shrink the market for itself. Hopes of quick fixes won't solve the structural mismatch between spending, revenue, and realistic adoption. The bubble isn't deflated by optimism, it's deflated by numbers. If you're invested in AI stocks, it's time to take a step back. Nvidia, trading above $700, is at significant risk. Consider taking profits before the correction hits. Big tech companies like Microsoft, Google, Amazon will survive, but their valuations will compress, so reducing exposure makes sense if you want to protect gains. AI startups are lottery tickets. Roughly 90% will fail, leaving investors with nothing. Only those with real revenue and a path to profitability might survive. The safest strategy is to diversify, limit your bets on speculative AI ventures, and wait for the post-crash opportunities. The crash will be harsh, but it will also create chances to acquire solid companies at reasonable prices. Patience and prudence will be rewarded more than chasing hype ever could. AI is real. Its capabilities are impressive, and its potential is undeniable. But the frenzy of investment, the hype, the astronomical valuations, they are all out of proportion with the revenue being generated today. The bubble will pop. Some companies will vanish, some will fail spectacularly, and some will survive, rebuilding on solid foundations. In the end, AI will become part of the background of our economy, like the internet, databases, and cloud computing, essential, valuable, but no longer headline-grabbing. The only question is whether you'll recognize the moment before it happens or only after the dust has settled. Timing the peak is impossible, but understanding the pattern can help you survive, adapt, and seize opportunities when the market stabilizes. The hype fades, reality sets in, and the survivors thrive.